Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Siding, and I'm just wrapping up this deep dive into evolution. So my conclusions are that evolution, given its stellar history and strong performance in fundamentals, it's surprisingly cheap here at 674, 675 kronor per share. It's down by a lot from 4 years ago when it hit a 1709 high. That being 4 years ago means that we are past 4 years of, let's say, a 15% discount rate. That amounts to 75% less discounting now than you should have done back then. So that adds to the potential. So all else equal, and a 60% lower share price now than back then means that, if you have a 60% lower share price, that means you're at about a 40% level, and you need to take that times 2.5 to get to a 100% level. So that is back to the peak. So that means that you have a factor of 1.75 less discounting, and you have a 2.5x potential for a total of 4.4x potential now than back then. That's how much cheaper evolution has become compared to then. And remember, the 50-year future history was just about the same 4 years ago as it is now. You have gotten your dividends in between, but that's it. In total, an investor is facing the same future that would have transpired, although we now know more, but they should have known better. Anyway, that's one way to look at how much cheaper it has become, or how much more potential there is if things were to return to normal. It doesn't matter really that the growth rate was 100% back then. They should have known what type of future growth rates would be more likely. And we as value investors, we would never have assumed more than, let's say, a 10 to 15% growth rate in the future. I would actually never put in 10% plus growth rate forever, but rather always use a kind of a ending state of GDP type valuation after 4, 5, or maybe 10 years if it's a very particular company and situation. I also make the judgment call here that their business model is durable, that there will be demand for their services, and that this is a high quality management and high quality products. That means they will get back on track. That is a judgment call. I am not qualified as a focused gaming system analyst. So this is simply based on historical numbers and trends that they have been able to capture this market, and they have poured in investment dollars into their systems and their client relations. So that's why I think that they will get back on track and at least be a GDP minus type of growth company, or a little bit less than the average company on the stock market. And on the other hand, I also think that they will have a higher free cash flow conversion level than the average company, meaning it's worth more in terms of multiples on free cash flow than they are on earnings per share. It's asset light, strong cash flow generative model. All these things they point to at least a market PE rating in the future when things calm down and you have less uncertainty as to the actual earnings level. So as I summarized in the CAGR section, Evo is already a good quality investment at this level. It's a lot of negativity built into the market price. However, the TA and macro headwinds, both for the company in itself and the market, are pretty heavy. So there's probably no reason to rush into the stock. I would, in a situation like this, but remember that I am often too bearish and too greedy in terms of wanting a really, really low entry price. That means that I do much less trades than most people. So that also means that I miss out on a lot of opportunities that just simply don't fall right down to my desired level. Anyway, I would have evolution very high up on my list of desired purchases, and I would set price alarms, perhaps at even 100 numbers, 600, 500, or a little bit above, to make sure that it doesn't turn just above these levels. So, for example, I about 20 to 25% lower yet than we are today. So around 500 to 550 kroner per share, or 45 to 50 euros per share. That would mean a PE of just 8 times last 12 months. That's a level where I would feel very confident to buy the shares in more volume. But already here at 675 is a good place to at least start nibbling a tenth of your end state desired position to have in evolution. And not least, put evolution into your short watch list of companies, wonderful companies that you compare to each other to see which one seems most attractive, both in terms of annual return potential and, of course, the perceived or the subjective level of risk. And that is, the risk discussion is always fraught with problems. And again, I always lose my words when talking about risk, because it's so intangible and so subjective. But unless we are completely wrong about evolution getting back on track or finding their footing in the business and at least growing with the economy, then at 500 kroner, at 7.5 times backward-looking earnings, there is so much upside, at least 100% upside in terms of valuation, if they were just to become slightly worse than average after that. And my final thoughts, they bear repetition, is that you should focus on the microeconomics, not the macro. So if you have something that's cheap and cheap enough, then it is worth a punt. And you should always be invested in stocks, or maybe a little bit of gold, but the part that you have set aside for stocks should be more or less 100% invested at all time. Just be in the right stocks, in the best price and the best risk-reward ratio you can find. So your or mine task is to simply keep this list of 5, 10, maybe 20 companies that we have under investigation, that we have in our watch list, to see how they rank against each other in terms of potential and in terms of subjective risk. Take the opportunity to use all the deep dives and enter them into your same watch list, and possibly also use, for example, the free online screeners to find similar companies and just sort back and forth to see what official or market consensus valuations you can see and how they rank toward relative them, and based on that you can make a relative call.